Hi, today we're going to talk about the 5C's of credit, and we're going to talk about some of the major vocabulary terms that you need to understand how credit works. Before we get there, there is one sort of general guideline or rule of thumb that is offered by financial experts, and that is the 20-10 rule. That is, if you are going to use debt, if you're going to borrow money, then you should borrow no more than 20% of your annual net income, excluding your mortgage. And your monthly payments should be no more than 10% of your monthly net income. That is your income that you earn after you pay taxes. Both of these are sort of upper limits. They're not something that you should necessarily aspire to. They're not something that you should be shooting for. They are the line at which you realize that you are in really bad shape with debt. So this isn't something that you're trying to achieve. It's something you're really trying to avoid, and you should never go above these numbers. When it comes to identifying your credit worthiness, that is, when it comes to looking at whether or not you meet the qualifications in order to obtain credit, we talk about the 5C's of credit. These are 5 different characteristics that impact whether or not you are able to receive credit from banks. One of the characteristics is called character. That is, if you pay off your debts on time, every time, you tend to be considered to have good character, and when you have good character, banks feel more comfortable with making loans to you, and they typically provide you with a better interest rate because they're not afraid that you are going to fail to pay them the money that you owe. We also talk about capacity, which impacts your ability to pay back loans, and we measure it in terms of debt to income ratio. We look at how much debt you have as a percentage of your total income. The higher that number, the more in debt you are, and the more difficult it becomes for you to pay off your loans, and as a result, you are less creditworthy in the eyes of banks because you're more of a risk to them. We also talk about collateral. Do you have assets that you can use to secure loans? That is, do you have assets like a car or a house that the bank could take from you to pay for the loan if you stop making payments yourself? We also talk about capital, which is the presence of any other assets that you may own that would enable you to pay off your debts. So if you have savings or investments, then that would enable you to make payments on loans, and therefore would make you more credit worthy because the bank feels more confident that you are able to get the resources necessary to pay them back. And then this last one, conditions. Conditions affect your credit worthiness because there are circumstances that may even necessarily be out of your control that affect whether or not you're a good risk or not. It could be a function of your job or the situation in the economy. If the economy is bad, banks tend to view people as being less creditworthy because they're worried that they won't get paid back. When the economy is going well, banks feel much more comfortable because they figure you have a good job, it'll stay on for a while, and they'll be willing to give you a loan because they feel like you're going to pay them back. So these 5 characteristics, these 5 criteria impact your creditworthiness in the eyes of banks. That is, it impacts their willingness to give you money. When we talk about loans and credit, there are certain terms that come up very often. One is the annual percentage rate, or APR, and the annual percentage rate is the interest rate that you have to pay over the course of the year to borrow money from the bank, because the bank wants to make sure that they get paid back all of the money they lent you, and so they charge you interest in one regard to make sure that if you don't pay back your loan through the entire course of the loan, that they will get as much money as possible, and also because you have to pay for the privilege of using somebody else's money. To figure out what your monthly percentage rate is, you would take your APR and divide it by the number of payments you make during the course of the year. In this case, if you're paying on a monthly basis, your APR divided by 12 will tell you what you pay in interest every month. So if you had a 12% APR, then you're paying 1% interest on the balance of your loan each month. And if you had an APR of 20%, then you'd be paying 1.67% because that's 20 divided by 12. Another term that comes up is the credit limit. Credit limit is simply the maximum amount of money you are allowed to borrow by the bank. So if you have a credit card, you might have a $5,000 credit limit, which means you can buy things up to $5,000 in total and then after that you can't borrow anymore until you've paid back some or all of that $5,000 that you spent. Available credit is the difference between how much you've spent and your credit limit. That is, how much credit have you used and how much is still available to you. So if you had a $7,000 credit limit and you owed $2,000, or you've already spent $2,000, then you still have $5,000 of available credit. The minimum payment is the smallest amount of money you owe the credit card company every single month in order to be considered on time. If you pay more than the minimum payment, that's fine, but you have to pay at least that amount or the credit card company gets upset. It's important to remember, though, that when you pay just the minimum payment, you're being charged interest on the remainder of the balance, the remainder of the amount of money that you borrowed and yet haven't paid off yet. And so it's important that you always pay more than the minimum if at all possible. The big reason being that when you only pay minimums, it causes the price of goods to be very, very high very, very quickly. It can take you years to pay off even small amounts on your credit card if all you do is pay the minimum payment. And over that time, you're paying a lot of money in interest on top of what you borrowed. The payoff amount is how much money you owe if all you did was make minimum payments. So it looks at your principal amount, that is the amount you borrowed, and it adds in all of the interest you will pay if all you do is make minimum payments. And it's important that you know this amount so that it gives you the real cost of your borrowing. And you find this in what's called a truth in lending statement. So in this example, the truth in lending disclosure for buying a house tells you the annual percentage rate, in this case 5.141%. It tells you how much money you would pay in interest if all you did was make your minimum monthly payments each month, and in this case it's $379,000. It tells you how much you've borrowed. In this case it's $393,000, and so you find that if you make just the minimum payment, that is you pay your mortgage payment on time every single month, then the $393,000 you borrowed to buy the house will end up being approximately $773,000 in total that you will pay to the bank. With your credit cards, it's the same thing. Credit card companies now are required to provide you with the truth in lending statement. And you can see in this example that while you may owe $1,786, all you have to pay as a minimum is $53. And that truth in lending statement tells you that if you pay only $53 and do not borrow any more money from this particular credit card, it will take you 8 years to pay off that $1,786, and it will cost you in total $2,785, which means you're paying $1,000 in interest by only making the minimum payment. The more you can pay, the better, obviously, because as you look here, if you pay even just $9 more per month, so instead of $53 you pay $62, that knocks the amount of time it takes to pay off your bill down from 8 years to 3 years and saves you nearly $550 in interest payments. Finally, the grace period is a period of time after you borrow but before interest charges are added to your balance. So if you're able to pay it all off before there's interest, before the grace period is over, then you don't have to pay interest. Typically, it's about 25 days, and it only applies to new purchases, meaning if you use your credit card and you buy something, you have essentially 25 days to pay back what you borrowed before interest applies. So as long as you pay your bill before the 25 days are up, you can borrow interest-free, but after those 25 days, you owe interest on the balance on your card.